Welcome to Trader Talk. I am Kenny Polcari, and I've got a big show for you today. First, my guest Mark Tepper is here, and then I'm going to give you the best recipe for cavatappi with pancetta and mascarpone cheese. It is fantastic. Now, before we get going, I want your input. Email me or send me a video of your Wall Street questions or what you're trying to figure out in this market at yfpodcast@yahooinc.com, and we'll try to answer it, maybe some of them even on the show. Now let's jump to the big take. Right now, markets are sending a very clear message, and it's not about earnings or inflation. It's about confidence. Investors are getting uneasy because political pressure around monetary policy is introducing a new layer of uncertainty into the system. We've seen stocks churn and drift lower, the dollar weaken, and gold and silver and other precious metals push to record highs, classic signals of a market that's shifting into protection mode. This isn't necessarily a negative, but it is something to consider as you allocate new monies to the markets. Let's be honest, there are a slew of headlines that are top of mind right now. Most of them geopolitical. Think Venezuela, Cuba, Iran, etc. It's about Fed independence. It's about earnings that started in early January, and it's about the tech trade. And are we in a bubble or not? It's about oil. It's about rates, and not the direction, but the speed of the coming rate cuts. It's about whether investors believe the Fed can operate independently and stay anchored to the data. In the end, when confidence gets questioned, markets start pricing in risk premiums, not fundamentals, and that's when volatility creeps in and up. The bigger issue here is that the administration can't seem to stay in its own lane. Trump is sending messages that he needs to put his stamp on everything, from how long Jay Powell is left to who the next chair will be, to the level that he thinks rates need to be, what he wants mortgage rates to be, while punishing credit card companies that are charging what he considers usurious rates. The market action being driven by a range of headlines that do nothing but cause a lot of noise and volatility for the individual investor. And that makes the market jumpier. Currencies more fragile and correlations less reliable. The key points here to emphasize: independence matters. Investors have historically priced monetary policy on economic data, not political fights. And when that changes, risk assets get hit first. Rate outlook now has political risk, even if the Fed wants to maintain a data-dependent path. Headline risk around governance can shift the expectations towards earlier cuts or more dovish pricing, boosting volatility. And volatility isn't just technical, it's behavioral. With gold surging and traders seeking safety, you see the market risk appetite bitten by the headlines, not the fundamentals alone. This big take blends monetary policy uncertainty with real market signals and makes a compelling opening for conversation with Mark Tepper about how political noise is affecting not just price action, but investor psychology and strategic allocation decisions. Let's bring in Mark Tepper, the founder and CEO of Strategic Wealth Partners, a high-performance wealth management firm guiding entrepreneurs, professional athletes, and affluent families to financial freedom with smart, tailored strategies. A competitive strategist at heart, Mark has spent over 2 decades building bespoke investment and retirement plans that win for his clients. He's also a best-selling author, national media contributor. You can always find him on Fox Business 2 or 3 times a week, as well as here on Trader Talk. Mark, thank you for taking the time out. It's always a pleasure to see you. I wish you were here next to me, but it is what it is. So I'll talk to you in Ohio.
Be a lot more fun, and I'll tell you what, the weather's probably better where you're at as well, man. It's been cold here in Ohio, and we've had quite a bit of snow so far, so I'm ready to get out of Dodge myself.
No, I'm actually in New York City, so the weather's cold here, right? I flew up yesterday from Florida.
Not much better.
It is cold here right now. Anyway, all right, listen, Mark, let's start broadly, right? Because markets don't like the uncertainty. And right now, there's a lot of uncertainty everywhere. And it's not just inflation or jobs, it's politics, it's geopolitics, it's this recent announcement surrounding, the DOJ and the Fed only adding to all this drama, right? So let's talk about this. How much do you think does this perceived pressure on the Fed actually matter for the markets?
I think it matters, Kenny, but at the same point in time, when we talk about investor sentiment, and you tell me if you agree or not, but it seems like the clients I'm working with, investors overall, everyone has begun to expect a certain level of dysfunction within the government. Whether we're talking who's going to be the chair at the Federal Reserve, or we're talking about geopolitical instabilities, or we're talking about government shutdowns over and over and over again.
Right.
Investors now are kind of just pricing that in, and they're just kind of motoring through. Where I see investor sentiment actually being disrupted probably in the second half of the year, Kenny. I think we got a green light in the first half. I think everything's looking very bullish, but where we're going to see a little bit of investor sentiment shift to the negative side is going to be in the second half of the year when, in my opinion, I think a lot of the AI winners are going to be separated from the AI losers. And that is going to cause some fear and panic. And at that point, that's when investor sentiment finally comes down.
Let me ask you a question. Just jump off track here for 1 minute. Do you not think that there's any risk in the first half of the year of a midterm election drama? All the new, the 435 seats are up for grabs in the House. There's gonna be a lot of new names on the, on the front cover. And where do they stand? Are they left? Are they right? Are they center? What's that mean? I think, because then I think it starts to whittle itself down by the time we get into the summer and you kind of see who the candidates are. So I'm in the camp that I think the first half of the year might end up getting a little bit volatile because of the midterm elections.
Look, I mean, you've probably seen similar research, but, when you go back and you look at the 4-year presidential cycle, year 2 is always the most volatile. And that's 2026. That's where we're at. The typical drawdown in years 1, 3, and 4 is 12%. In a midterm year, it's 19%. And that's specifically due to everything you just mentioned. There's concern over who's going to be the next governor or whatever it might be. There's all those midterm concerns. What I think is going to be the core thesis that actually drives us through the first half of the year is this consumer that has been completely underrated and underappreciated. I mean, Kenny, you look at a lot of the recent economic data, inflation's coming in way lower than anyone would have ever expected. Economic growth is coming in higher than most people would have expected. Real wage growth, which in my opinion is the number one indicator you can look at to determine whether or not affordability is actually happening, whether or not things are becoming affordable. Real wage growth has been positive. And then on top of that, from the one big beautiful bill, we're expecting an extra $150 billion in tax refunds hitting mailboxes over the course of the next few months. And Kenny, consumer discretionary was a terrible sector last year. I think it was up 5%. Market was up 16, 17. It's one of the best performing sectors out of the gate so far this year. And I think you can find some really good opportunities there, at least through the first half of the year when the consumer is essentially running on this extra fiscal stimulus.
So, you brought up an interesting point, which I think, the listeners should be very aware of, is that because I too expect a drawdown, right? I expect this drawdown. We're in an election year. It should not surprise anybody if we see, the S&P pull back 15, 18, 20%. Now it's going to get uncomfortable. It's going to get, you're not going to feel good about it. But as long as you remain kind of in a well-diversified, what you own kind of portfolio with the biggest names in the sectors you want to be in, you have to kind of understand that you're probably going to have to ride that wave, right? As a long-term investor. If you're a day trader, you're going to be in that, you don't really care.
Without a doubt. And actually, if you go back through history and you look at the time it takes during any bear market for the market to peak, hit its trough, and then get back to its break-even point, it's on average like 1.5 years. Now, if it's a financial crisis, like the Great Recession or even the tech bubble before that, which I consider a financial crisis because you had revenue-less companies like Pets.com going public. Those take longer to recover from. Those are like 4 years to recover. But when it's a policy-influenced bear market, so you go back to Liberation Day in April of last year, you go back to the COVID lockdowns of 2020, the rebound, Kenny, is so much quicker. I mean, we're talking, I think the rebound in 2025 was like maybe 1.5 months.
We saw how, And not only did we get the rebound, but then we had the rebound plus, right? Because the market just kept going, right? It just, 100%.
And the one thing I've been telling my clients, Kenny, is that, we would welcome a 19% pullback because we're going to be opportunistic. Now, they don't want to hear that.
No, right.
But what I'm telling them is like, look, we're going to be opportunistic and we will be rotating out of those defensive names that held up better during that drawdown.
Right.
And we're going to be moving into those growthier positions that are better poised to rebound on the back end.
Right. But I will say, and you made this point early on, is that, investors are now coming to realize that they're just going to get used to this chaos that we get, right?
Yeah.
But I also do think that investors, at least, clients that I'm talking to, everything, they are well aware that there's going to be a correction coming, and it's not one that they should fear. Their portfolios are well balanced, they're well diversified, and taking an opportunity if the market backs off like that is always the right answer.
That's unquestionably the correct move. But Kenny, you got to have discipline to execute that move.
Right.
For example, if you think you want to buy NVIDIA if it ever goes below $150 again, you better write that number down, keep it next to your keyboard, and when it gets there, you better buy it.
What happens is you write that number down or you have it in your head, but then when it gets there, you still get nervous going, oh my God,
You're
I can't
afraid.
do it. Exactly.
Yes, you're afraid and you break your own rule you set for yourself. So set your rules, be disciplined, and stick to it. That is the best way you can improve your investment results over time.
There's no doubt about it. So if the Fed says that they're data dependent, but investors think that politics are now creeping in, right? And the politics are going to affect the way the Fed reacts. And which, by the way, I think Jay Powell's now dug his heels in. I don't think Jay Powell's going to react at all. I think if Jay Powell, if Donald Trump thinks Jay Powell's going to start cutting rates just because of this DOJ investigation, I think there's nothing coming. I think Jay Powell's going to say, not happening.
Absolutely. Yeah.
Right.
And look, I mean, the Fed has seemed to be somewhat political now for quite some time.
Right.
Obviously, it seems like there's a little headbutting going on between President Trump and Jay Powell, to say the least. But look, I mean, at the end of the day, my opinion is rates are high. Are they ridiculously high? No, they're probably getting closer to neutral.
Okay.
But affordability remains an issue, and that's something that I think that resonates with every single American, not just Americans that have large investment portfolios, is affordability. And with inflation coming down and economic growth being good, but not producing the jobs, right? I mean, the Fed's dual mandate is full employment. It doesn't say strong economy. It is very possible that we see a higher unemployment rate for the next several years just due to AI productivity enhancements.
Exactly.
And that's something we're all going to have to get used to. Whoever's running the Fed is going to have to get used to having, dealing with a higher unemployment number, but it's still being considered full employment.
That's right. Hold on one second. We're going to take a quick break and we're going to come right back. Now, I want to ask a question. Yes, all those points are well taken, and I agree with every one of them, which is why I think kind of where we're at. I think the Fed has made a number of cuts. I think we're down at 3.5, 3 3/4 right now in Fed funds rate. Yep. I think you got to give it a little bit of time, which I think that was Jay Powell's plan all along, just to give a little bit of time to see what happened. But now that they came out with that investigation, I think he really dug in. And I don't think he's going to give him the satisfaction unless somehow they throw him out, which I don't see how they're going to do.
Yeah, I know. I mean, I agree. And I've been saying, and I think you've been saying this too, Kenny, for the last several years, and we're on the record. You can go and find the videos. We're out there saying it. But we should not have been in restrictive monetary policy territory for the last few years.
Agreed.
You and I never said we should be in easy territory.
That's right.
But we should be at neutral, right?
That's right.
I mean, that's what. So what I can say as far as my criticism of the Fed goes is that I think it took them a little too long to get to where they needed to be, but I don't think they need to go much lower, to be honest.
No, and I don't think that. Listen, it took them too long to go higher when they had to go higher, and we knew that.
Right.
Every week we're on TV going, "What don't you see?" As inflation is spinning out of control. Then on the other way, it came down. Yes, to your point, maybe they were a little bit slow, but I agree with you. I think we're closer to neutral than not. This idea of another 100 basis point cuts in the federal funds rate, I'm not sure I agree with that at all. And look, if the issue is affordability with housing is what we're talking about, right? Then if they leave rates where they are and mortgage rates stay at 6%, people that ultimately are going to have to sell their houses, whether they're getting old or somebody dies and there's, the house is going to come, they're going to just have to recognize that the price may not be what they think it is. It's going to cause a natural buyer and seller reaction, right? If they cut rates down, they lower mortgage rates, I think it's only going to fuel the price of houses once again.
President Trump, in my opinion, does not think the Federal Reserve is going to cut anytime soon.
That's right.
Whether it's Jay Powell or somebody else. And that is why he is now going down different paths to make things more affordable.
Right.
That's why he's trying to cap credit card interest rates at 10%.
So talk about that. He's now trying to cap that at 10%. How do you think that goes?
I think that backfires. So
Yeah.
I think at face value, the public reception of that is going to be very positive. Because who wouldn't want their 29% credit card to come down to 10%?
Right.
Everybody wants that. Okay.
Right.
But Kenny, I don't know what interest rate you pay on your credit card, but mine is 0% because I pay it off in full every single month.
That's right.
Okay.
That's
so
right.
what will happen here if you force companies to only charge 10%? They're going to change their underwriting guidelines.
Right.
And they're only going to extend credit to the most credit-worthy customers.
Right.
So if you have let's say a 720 plus credit score, congratulations, you get a 9.99% credit card. If you have a 680 credit score, sorry, you get no credit. So what that actually does is it backfires on the people that I think they're trying to help.
Right.
That's
right.
what hurt.
Unless, of course, he caps the rates and then he tells them they can't deny anybody, right? That'll be the next headline. Okay, we're capping it, but you can't deny anybody.
Well, either.
You got to give everybody their money. I don't know. It's again, to your point, it's another dramatic headline that that we're going to be forced to live with, right?
But he also he's coming after the single family home ownership by institutions as well.
Right.
Again, if the Blackstones of the world unload all those single family homes, prices will come down.
100%.
And that's how you improve affordability, because he knows mortgage rates are not coming down, man. I mean, they're not. They might come down another 0.5% over the next year or two, but not by a lot.
Listen, Mark, Trump also came out last week, as we're talking about affordability. He came out last week and he's instructing Fannie Mae to buy $200 billion worth of mortgages, right? To try to take supply off the market and then cause those longer term rates to come down. I don't think that's going to work. I mean, that might be a short-term fix. I don't think that's a long-term fix at all.
Anyone who wants to learn the basics of economics, I highly recommend you pick up a copy of Economics in One Lesson by Henry Hazlitt. I mean, it's a short book, and I'll just give you the punchline. I mean, the lesson is that, bad economists make short-term decisions on how an event has a short-term impact on a small group of people. Okay?
Right.
Smart economists look at the longer-term implications of that event on everybody, right? And I think at the end of the day, a lot of these, they appear like Band-Aids, but they're not going to be great long-term solutions, whether it's the 10% max on credit card interest or the defense companies, not being able to pay dividends and share buybacks and things like that.
Right.
Eventually, you may have a more negative outcome.
Yeah. No, I think you're right. I think you're absolutely right. Which is why I think that whole it sounds good. Rates going to come down. I don't think it's going to come down for very long, and I don't think it's the right answer. First of all, where are they going to get the money? What are we just printing money to get them to go out and buy? I mean, there's a whole lot of questions there. So let's just turn to really quickly before we end here, because we're going to run out of time, is precious metals and gold and silver. Once again, they're ticking at new highs on the back of the weekend data, right? On the back of the Fed news, on the back of all that stuff. And so what's your sense of gold? Is gold going higher in 2026? Do you think it's going to kind of top out for a little bit? I mean, look, it's had a massive move over the last 2 years. 24 and 25 saw gold up, 35% and 50 or 60% in 2025.
Yeah, and you're not going to see that this year. I would think maybe we get to $5,000, which is what, maybe 10% or so from here.
Yeah.
But that's it. At that point, I can't see as much new money coming into gold at 4,500 an ounce or $5,000 an ounce. I mean, we've been advocating to our clients for years and years and years. It makes sense to hold a 3 to 5% position
Right.
in gold because gold tends to be a good hedge against both inflation and deflation.
Right.
It's a good risk-off asset.
Right.
But if I had a client coming to me today and all of their money was in cash, would I tell them to put 5% of that cash into gold at $4,500 an ounce? The answer is no.
Yeah, I would. Yeah.
Maybe dollar cost average up
Right.
to that level over the course of time,
Right.
but no. I mean, I think gold has had quite a run. I think once it gets somewhere around 5,000, you're going to see it go back to its normal kind of returns. I'm not predicting any major crash in gold.
Right.
It's not like it's going to hit 5,000 and go to 2,500 the next few months after that.
Right.
The best returns are behind it.
Right. Talk to me about where you see volatility, because once that volatility really starts to lift its head, once it starts to punch up and through the trend lines, then you'll see the market get more anxious. But at the moment, I'm not so sure I see that happening anytime soon.
I don't see it happening anytime soon. And that's why kind of at the beginning of our conversation here, I mentioned that the second half of 2026 is what's most concerning to me because, you look at all of these artificial intelligence companies, and you've read the research, you know the data. Over the course of the last several years, since November of 2022, when ChatGPT was introduced, all of their CapEx has come from either cash flow or it's come from these cash war chests that they had on the balance sheet.
Right.
Well, the amount of cash on the balance sheet is now down to like Great Recession kind of levels, tech bubble levels, right? Like it's low, incredibly low right now.
Right.
So over the course of this year, and latest evidence would be Amazon wanting to raise $10 billion of debt at the end of 2025, more of this AI spending is going to have to be funded by debt.
Right.
As soon as you introduce debt into the equation, it's no longer considered R&D, research and development. Now the investors are looking at ROI,
Right.
return on investment. What have you done with that? Why is this spending so reckless? What are the results? That, Kenny, that is where the volatility is going to really pick up in the second half of the year when you start to see some of these things shake out.
No, get it done. Listen. Today, I'm going to give you the cavatappi with pancetta and mascarpone cheese. It is a simple yet delicious dish. It's a modern Italian classic rooted in tradition, but really shaped by evolution. Cavatappi means a corkscrew, right? It emerged in southern Italy in the 20th century, designed to kind of trap the sauces better than a straight pasta would. Perfect for rich, creamy preparations. Pancetta, well, that's been a cornerstone of Italian cooking since the Roman times, prized for adding depth and savory fat without smokiness, right? And the mascarpone cheese, originally from Lombardy, was traditionally a dessert cheese. You use that like in things like tiramisu. But post-World War II, Italian cooks began using it in savory dishes as a softer, silkier alternative to cream. This combination grew out of the same lineage as carbonara con griscia, right? Pasta and cured pork and fat, but reflects a newer, more indulgent style, especially popular in northern Italy and Italian-American kitchens here at home. Mascarpone mellows the salt and the sharpness, creating a luxurious, round sauce that clings beautifully to the corkscrews. You can scan the QR code on the screen for the full recipe, and trust me, you can thank me later. That's a wrap for today's Trader Talk, but the conversation continues. Subscribe on Apple Podcasts, Spotify, Amazon Music, or wherever you get your podcasts. Until the next time, stay sharp, stay disciplined, and stay in touch. Take good care.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.